We spent quite a bit of time talking about bonds. Bonds are obviously really important from the economy standpoint, from a macroeconomic standpoint. We really pay attention to bonds. The Federal Reserve's interactions with the bond market, really important in terms of thinking about how the economy operates. When we think about the governmental debt and implications related to the governmental debt, that's all connected to the bond market. And for individual investors, very likely you'll be investing in bonds, certainly closer to the end of your career. So it's something you definitely need to know about. Maybe a more flashy topic, however, is stocks. And in my eyes, stocks are kind of interesting in the fact that what appears to be very complicated about stocks is really that there's just a tremendous amount of randomness. So in my eyes, stocks are one of those things that you need some general know-how for it, some general analysis. But when it comes to investing, most of you are going to choose to invest in very simple ways. So what's interesting about stocks is there's a lot of analysis on it, and the research shows a lot of that analysis is really quite pointless. So we're going to do some of the technical stuff, simple technical analysis, and then we're going to bring it back and think about things practically a bit. So this comes out of Chapter 8, if you happen to be using the book some in this class. And we're going to start right from the basics. Remember that this class does not have a prereq in terms of any finance course. So some people are coming into it with not much knowledge. But I suspect all of you at least know this. Stock represents just ownership in a company. So if you go online right now and you go to Ameritrade or Robinhood or something and you buy one share of Apple, that means you're buying a little tiny piece of Apple. So you are a shareholder for Apple. And that gives you some rights. If you own a bit of Apple stock, what that means is that you have voting privileges. So just if you were the owner of some small private company, if you're the owner of stock, you actually have some voting privileges. So if you believe the CEO is doing a really poor job, there's a chance that you'll have the ability to vote that CEO off the executive board. You also have the ability to claim profits. Now, you can't just, take your stock and take it to the company and say, I'd like some profits. But it does give you the ability to have a claim on profits that company receives. And a term related to this that you'll sometimes see in the literature is that stockholders are residual claimants. And what that means is you don't earn, let's say if Apple sells an iPhone, you don't just get a chunk of the money that happened from that sale. But rather, if at the end of the month, for example, Apple has turned a profit, that profit will be distributed to those shareholders. And there's a couple of different ways that they can do that. So this is termed residual claimants because the stockholder gets profits last in line. So, if you're thinking about Apple and they're making a cell phone, when they sell that $1,000 cell phone, they're going to pay their workers, they're going to pay anybody who's lend them money. Like if Apple's issued bonds, they're going to pay those bond buyers back. They're going to pay the government in terms of taxes. They're going to pay for raw materials. There's all these things that need to be paid. If after all of that is paid, there's still some profit left over, that is what goes to the stockholder, which is really no different from ownership in any other firm, right? The owners are kind of the last person to get paid. But if the company does a good job, there's a chance there's a lot of money left over after all the other costs are paid out. All right, so maybe that's bad news in a way because it means you're the last person to get paid, but there also is good news in that the stockholder has limited liability. And what that means is, in regards to limited liability, is you can only lose what you put in. And this is true for just buying stock in a traditional standpoint, right? Just going long on stock, just buying shares. There are ways to, buy on margin, option trading, things that can get a little bit more complicated. But just for regular trading, if you're just a normal shareholder, what that means is if the company goes bankrupt or something, or there's some, sexual harassment charge, you're not going to be faced with any of the potential penalties of that. If you buy $1,000 worth of Apple stock, worst case scenario, you just lose your $1,000. All right. So unlike another owner, like an owner of a private business, it's not like you can go bankrupt or be forced to give up some of your assets if that company is failing. All right. So that's real basic stuff when it comes to stocks. And that's a good starting point. Lots and lots of companies issue stock, a lot, but not all. When you think about small businesses, if you're in downtown Milledgeville, those businesses, those local businesses there, and they're not issuing stock. They might have a few private investors. But as a company gets bigger, a lot of times they feel compelled to issue stock. And the reason they do that is when a company issues stock, they get some cash on hand. So you may have heard of the term IPO before. This is the initial public offering. And basically what we're saying here is we're trying to answer the question, why does a company ever want to issue stock? Why do they want to give up some of their ownership potential? Okay. The goal here is to get cash that can then be reinvested in the company. So when a company that is not publicly traded decides that they would like to issue stock and become publicly traded, they will have an initial public offering, an IPO. Okay. And what this means is the company will basically sell off a portion of itself to get cash now. All right? So, Facebook, when they had their IPO many years back, it was really a long time ago at this point, but it was a very important IPO because we had this social media company that was really relevant culturally, but it was kind of hard to see them making a big profit at that moment in time. When they issued stock, the reason they wanted to do that is so that they could get more cash on hand that could be invested into that company, back into the company to try to make more profits. So eventually Facebook, would buy Instagram, for example. It'd be hard for them to make big purchases like that if they didn't have an IPO, which gives them cash on hand, okay? So if you're an individual that believes a company like Facebook is going to become profitable, you're willing to buy stock to get a share of that company. And in turn, Facebook takes that money and ideally would become more profitable as a result of it. So it can be win-win, win for the investors and win for the executives at Facebook. Sometimes this is kind of confusing to students, though, because, if we think about this, is stocks a form of borrowing? Stocks aren't really a form of borrowing because the company never really has to pay it back. However, in another way, if the company has profits, they will pay back the shareholders. So this does make the stock market somewhat similar to issuing bonds, okay? And in fact, if you think about it, there's two ways for companies to raise funds. One, they can borrow money via bonds, and they'll have to pay it back. Or secondly, they can have an IPO and issue stock. In both cases, they're getting cash, and in both cases, they're going to have to pay back some cash. The difference is for bonds, the amount they have to pay back is guaranteed, whereas the amount they'll pay back with stocks is just based on their profitability, okay? However, after the IPO, if the company doesn't issue more shares in the future, at that point, any money that changes hands is no longer a regular form of lending, okay? After the IPO and after all those initial shares are sold, so maybe Facebook sells 10 million shares at their IPO, after that, the shares are sold on the secondary market. And what that means is, if I buy Facebook stock right now, I'm not giving Facebook any money. I'm just giving money to someone who owns a Facebook share, right? The owners of Facebook, as it turns out. All right, so if I go online and I buy $10,000 worth of Facebook stock, I'm buying shares not from Facebook, but from someone else who owned those shares. So if we see like this big event, like for example with GameStop, it's 2021 right now, right? GameStop just exploded, went up, several %1,000 in value. When their share price goes up from $1 to $200, GameStop, the company, doesn't get anything from that, right? They're not getting extra value on that. The owners do, but GameStop itself is not benefiting from that, you see. So since it's on the secondary market, that doesn't benefit GameStop. It's kind of like saying, think about a bond on the secondary market. If I borrow money to start a business, someone now owns a bond. And if that bond gets sold for billions of dollars, that doesn't affect me one bit. I still have to pay it back. It doesn't change anything about the terms of the loan. All right. So we got to recognize that when we are trading stock, we're trading it on the secondary market. All right. So we start out with an IPO. That's when the company issues shares. In the future, they may eventually issue new shares. That's possible too. But more than 99% of the time, if you're buying stock not from the company, but from other shareholders. Okay. Trying to just go through the basics here of stock. So, this is kind of going to be all over the place. Got all these ideas we need to discuss, and there's no really good order to carry them in. All right. So we saw a little bit of information about what a stockholder is. We think about IPOs. Now let's talk about thinking about how much money is in the stock market in terms of value. So let's think about valuing the stock market. If we were trying to figure out how much stocks are worth today collectively, or if we're trying to figure out how the stock market is doing, there's a couple of places we might look. One of those is the Dow Jones Industrial Average. And this is all the kind of stuff that you really just need to know. If you're the type of person who's going to be in business, certainly if you're the type of person who's going to be in finance, you need to have a little bit of knowledge about things like the Dow Jones Industrial Average, even if they're not really all that useful. Just because they get brought up in conversation, and you're going to look like an idiot if you don't know what the Dow Jones Industrial Average is, all right? The Dow Jones Industrial Average is the 30 largest corporations, the 30 largest publicly traded businesses in the U.S. And companies can move in and out of the Dow Jones Industrial Average, all right? So when a company gets much bigger over time, so like when a company like Amazon explodes in value, it will enter the Dow Jones Industrial Average. On the other hand, when a company is becoming less valuable over time, their stock shares are losing value, then they'll exit the Dow Jones Industrial Average like GE or GM, okay? And so what that means is this is a constantly evolving list. And if I'm not mistaken, I think at this point there are no companies in the Dow Jones Industrial Average that were there when it first begun. I think there's none. There may be one. But that just goes to show how much cycling there is, how much changes over time, okay? So this is a constantly evolving list. What's weird about the Dow Jones Industrial Average is it's a really crappy index, all right? It is a very poor indicator of how the economy is doing. And there's a reason why it's a bad indicator, all right? One reason is it only has 30 companies. That's bad already. But that's not really the big problem. The big problem is that the Dow Jones Industrial Average is price weighted. Price weighted. Okay? What that means is you could kind of think about it this way, all right? If we're going to try to figure out what all stocks are worth in terms of adding them all up, trying to figure out like how much value there is, imagine if some teeny little penny stock went up 1,000% today, all right? So imagine there's some teeny little penny stock. It's worth only a few $1 million collectively. All the shares are only worth a few $1 million. Imagine it goes up 1,000%. Is that a big deal for the economy? No, right? Meaningless. That kind of stuff happens all the time. It's not a big deal. On the other hand, imagine if Microsoft went up 1,000% today. That would be a humongous deal. That would be $18 trillion in gains happening in one day. That would be massive, okay? So the problem with the Dow Jones Industrial Average is it treats all the companies as if they are the same size, and rather than thinking about how big the companies are, it focuses on the price of the shares, which is really dumb, okay? So the value of the index is based on the prices of the stock shares. So let me just try to give you a little example of what I mean by this, and you hopefully will understand why this is a problem, okay? To do that, I'm going to use a little bit of terminology that we'll gradually introduce as we go through this. But let's imagine that Microsoft, I'm just going to make up some numbers to begin with here. Let's imagine that Microsoft is worth $2 a share, all right? And at the same time, Boeing, airplane manufacturer, is worth, let's say, $198 a share. All right, now what you probably know is Microsoft is a much bigger company than Boeing. All right, Microsoft is one of the two largest companies in the United States. It's worth about $2 trillion in total value. Boeing is also a big company. If I'm not mistaken, Boeing is also part of the Dow Jones Industrial Average. The problem with the way the Dow Jones Industrial Average is set up is these prices, which are really arbitrary, those are going to drive the index. All right. The thing about Microsoft is it could have 1 trillion shares issued. There might be 1 trillion shares. There could be 10 trillion shares. The number of shares they issue is really irrelevant, right? It's kind of like, imagine if you take a pizza and you cut it in half, or you cut it in 50 slices. Either way, it's just one pizza. So the number of slices it has doesn't really change what you're dealing with. A pie of pizza, okay? On the other hand, Boeing, maybe they've tried to slice their pizza up fewer times. So although the share price is really large, they might only have 1 million shares issued. Turns out this is a really apt example because this is actually kind of what happens in this market. I'm exaggerating here, but this is exactly what we see in the Dow Jones Industrial Average. Boeing's share price is just really high for no good reason. And Microsoft's is relatively low compared to its value. So here's the problem. If we were going to create an index that only had 2 companies, and we did it like the Dow Jones Industrial Average did, then we could kind of think of it this way. The index for this little miniature 2-stock asset that we've created here would have a total value of $200. Okay? So you just add up the prices to figure out what the index is worth. And what that would mean is just 1% of this market, or of this index, is Microsoft, right? 2 divided by 200, that's 1%. So even though Microsoft is a bigger company, it is only worth 1% of the index simply because its share price is arbitrarily low. And of course, on the other hand, Boeing would be 99% of this index. So this is going to create a pretty big problem. Well, what if Microsoft has a really good day? What if Microsoft goes up 3% in value? It's not really going to affect the index because it has such a low price. Okay? On the other hand, if Boeing goes up 3%, it's going to look like there's this huge heyday. So if we're thinking about trying to figure out what all the stocks are worth, this is a really, really bad way to do it. Okay? So the Dow Jones Industrial Average is a very bad index. And what's funny is pretty much everyone knows this. It's just that the Dow Jones Industrial Average has become so commonplace. We're just so used to it that it's discussed in the news. It's discussed even amongst finance professors and academics. But it's a really crappy index. Even the guy who made the Dow Jones Industrial Average is like, I wish I hadn't done it this way. This is really a stupid way to set this up. So if instead we're trying to figure out how the economy is doing, or rather how the stock market is doing in general, we really don't want to look at the Dow Jones Industrial Average because of the way it's price weighted. Instead, we would want to look at the S&P 500, the Standard & Poor's 500. This is always an index I look at, okay? Since I know what it shows me, I care way more about this index. The S&P 500 is the 500 largest corporations in the U.S. Okay? And so off the bat, that makes it a better index that it has 500, all right? Why does it have 500? Why not 1,000? Why not 2,000? Well, there's a lot of stocks, a lot of penny stocks that kind of go away. They go to zero. They get bought out. There's a lot of fluctuations if you think about the lower end companies. Among the 500, this is companies that are pretty stable, all right? But you're still getting a big share of the overall stock market. Way more than 90% of the stock market's overall value comes from these top 500 companies, even though there are about 3,000 total tradable companies in the United States, if I recall correctly, all right? So this is only about 1/6 of the total stock market in terms of companies, but it's more than 90% of the total value, okay? You got all your big companies here. And the beauty of the S&P 500, and really just about every other index that exists, is that it is value weighted, which means it is based on market cap, not the price, okay? Okay, now we got to define that term, market cap. It's probably a term you've seen before if I had to guess, but just in case, the market cap, short for the market capitalization rate, is the total value of the company in terms of shares. Okay, so you take, to solve for the market cap, you would take the number of shares that exist, which is commonly referred to as the shares outstanding, and you multiply it times the price per share. And in doing so, you don't run into that weird problem where, you know, Microsoft just has issued way more shares. The more shares you've issued, the lower your stock price will be. But again, it is very arbitrary. Remember, we talked about cutting up that slice of pizza. You can cut up a slice of pizza 1,000,000 times. It is still the same slice of pizza, okay? So what we're saying here is we're not going to think about just the price per share. We're going to think about the total value, all right? This is a much better way to do this because what this tells you is if a company like Microsoft goes up 1%, that's going to be way more meaningful in our index than if a smaller company like GameStop goes up 1%, okay? So to see how this is solved, again, I'm choosing just to make these really simple indices. I can't show you 500 companies and solve for it that way. That would take forever. But imagine if we wanted to make just a teeny tiny little index that just had 2 companies. Again, let's go with Microsoft and Boeing. All right, so we've got their share price. And just, you know, I'm just using silly numbers here, but let's imagine that the number of shares that exist is 1,000 for Microsoft and just 1 for Boeing in this simple little example. This is the beauty of the S&P 500, okay? We're not just going to look at the share price, right? The share price is arbitrary. The number of shares outstanding, that's also kind of arbitrary. But if you multiply them together, it gives you something very meaningful. It tells you how much all the shares are worth. It tells you the total value of Microsoft. So if we multiply these together, we would get the market cap. All right? So that would be our market cap. And so when it comes time to think about how much the index is worth, you see, now Microsoft has a much bigger overall value in the overall asset. So this index here, whatever this comes out to, when we divide 2,000 by 2,198, that would show us the percent of the index that is Microsoft. Sorry for running out of space there, okay? But that comes out to how much is Microsoft here, all right? So I don't know exactly what that comes out to. Let's say it's 90%, okay? Then what that means is 90% of the index is Microsoft. Not arbitrarily, but because Microsoft is 90% of the value, okay? Microsoft's way bigger. Okay? For Boeing, on the other hand, they're going to make up a much smaller share. Same deal. Take the market cap for Boeing and divide it by the total amount of market cap, and it would show us the percent that is Boeing. So that's how the S&P 500 is weighted. And in doing so, it takes the companies that are most important and values them correctly. So if we think about how we could interpret the information here, if you hop onto any kind of a financial website, they're going to show you a few different tickers. One is definitely going to be the Dow Jones Industrial Average, and you'll see something like it's up 0.6%. I look at that and I'm like, I don't really know what that means. Maybe just Boeing's having a good day because Boeing has a high share price, right? And it's only 30 companies. So if I have like a really diversified portfolio and I'm owning a bunch of stocks, if I see that this is up 0.6%, sometimes my overall portfolio will still be down. This is just not very useful information. Whereas on the other hand, if I look at the S&P 500 and it's up, let's say 0.3%, that is extremely meaningful because the 500 largest companies, which make up more than 90% of the overall stock market, are included in this. So this is saying the 500 biggest companies, more than 90% of the overall stock market, is up 0.3%. This is a really good indication of what's happening in the stock market as a whole, okay? Also, for that same reason, there's something called an index fund. Something you should learn a lot about. If you have not taken personal finance, spend a little time learning about index funds. You really need to know what these are, because probably you're going to be investing money in index funds, perhaps most of your money in index funds throughout your life. An index fund is just a collection of stocks that are chosen based on predetermined rules. And what I mean by that is, there's not somebody going in and picking the stocks. There's not someone going in and speculating and saying, I think GameStop's going to go up, so I'm going to buy a bunch of GameStop or anything like that. An index fund is just a big pile of stocks, and it's chosen for a reason. There's a pathos, or an ethos? Yeah, there's an ethos in terms of why those stocks are chosen. So one really common index fund, and the reason I bring this up now, is you might invest in an S&P 500 index fund. And what that means is you're literally just buying all the stocks that are in the S&P 500. And just like the S&P 500 values bigger companies more, you're going to buy bigger chunks of the company. So companies like Amazon, Apple, Microsoft, you're going to buy a lot of that because they're a big chunk of the overall index. And then smaller companies that are still in the S&P 500, you're going to buy those, but a smaller share. So in other words, you're just going to mimic the S&P 500. And if you invest in the S&P 500 index fund, if it goes up 0.3%, so does your index fund. So you could just, let's say you have $100,000, you could just invest in the S&P 500 index fund, and you've managed to have a diversified list of stocks there, okay? Depending on who you are, that was either all incredibly easy or a lot to take in. We're starting kind of simple, but if you've never seen these things before, I definitely encourage you to spend a little time reading. Just jump on Wikipedia, look up the S&P 500 index fund, look up price weighted, look up value weighted, take in these ideas, read the book if you have it. If these things do seem easy to you, fine, I understand. We'll be adding more technical analysis to this in the later videos.